Good afternoon and welcome to Patria Bank's teleconference for the presentation of the financial results for the first half of 2025. Before we begin, I would like to remind you that this teleconference is being recorded. The recording will be published, and by joining this call, you automatically and implicitly consented to being recorded. If you do not agree, please disconnect at this time. Let me briefly walk you through today's setup. My name is Zuzanna Kurek, and I'll be moderating today's teleconference. Joining me today are Valentin Vancea, CEO of Patria Bank, Georgiana Stanciulescu, CFO of Patria Bank, Razvan Proda, CRO of Patria Bank, and Razvan Pashol, Manager of the Capital Markets and Investor Relations Department. We will start this teleconference with a review of Patria Bank's performance in the first half of 2025, followed by the look at the macroeconomic context and an overview of the key financial and operational results. We will then move to the commercial and operational development, digitalization, and as well as information about Patria Bank's shares and bonds, as well as updates regarding bank's shareholders and management. After the presentation, we'll open the floor for Q&A session. Please note that all the participants shall be on mute. If you wish to ask a question, we invite you to submit it through the chat window. I will be moderating the Q&A session, and for the benefit of those who will rewatch the replay, I will read each question out loud before our speakers provide an answer. Your questions will be addressed by the management team present with me today. I would like to also point out that today's presentation may include forward-looking statements regarding Patria Bank's future performance. Actual results may differ materially. Please take into account the disclaimer included in the presentation, which you can right now see on the screen. This disclaimer applies equally to all forward-looking statements made during today's teleconference. Thank you all for the attention. This concludes the introductory part of today's call. I would like to now invite CEO of Patria Bank, Valentin Vancea, to present the key aspects of Patria Bank's performance in the first half of 2025.
Thank you, Zuzanna. Hello, everyone. Thank you for joining our investors meeting, whereby we will go through the main results of Patria Bank in the first semester of 2025, which we are all aware that it has not been a very easy context in which we have all performed our activities, with many turmoils, both on political side, on macroeconomic development. But despite all these, I would say, economic context and political turbulences, Patria Bank succeeded to have a very sustainable and robust development in all areas of activities. I would follow up the solid development of our performing portfolio, which is based, of course, on sustainable growth of the new sales. We have a double-digit increase of the new sales in the first semesters of this year compared to previous years, meaning a 42% increase of the new sales. This development was achieved in all areas, in all segments, commercial segments, be it corporate, small business, micro, agro, and also retail. The new sales in the first semester reached approximately RON 860 million, which, as I mentioned before, is more than 40% increase compared to the RON 605 million in the previous year. For us, very important is the commercial funding, and this year we have succeeded also to have a double-digit increase, which shows the confidence of our customers, namely an increase of 18% compared to the previous year, so that the outstanding balance of our commercial funding has gone very close to the RON 3.8 billion level. We have also, as mentioned before, which is a main driver for our interest income, significant increase of our performing loans. Again, a double-digit increase, 21% of the performing loans to RON billion RON. More details regarding this structure of the new sales, as mentioned before, 860 million RON. A very important increase comes from the loans to legal entities, which represent 2.1 billion RON as of end of June this year, representing an increase of 16% to last year, December results, and respectively compared to the previous semesters in 2024. And also in the retail part, we have a 10% increase of the total balance sheet. Agro always has and micro represented a very important segment of customers. As mentioned in the previous investors meeting, we have changed our strategy when it comes to the agri and food segment, and also we have touched the food processing area. Here we have obtained an increase of 33% as of end of June compared to the previous December 31st year. And also in the micro segment, a 15% increase. I would like to mention now that one of the main drivers of the development of the portfolio for the small business and corporate customers is represented by the competitiveness guarantees, Patria Bank being one of the most important users of this type of guarantees. More details regarding the business results and the segmentation will come later, and I would like now to invite my colleague Georgiana to develop a little bit more on the macroeconomic context which we face during this semester.
Good afternoon, I'm Georgiana Stăncilescu, Chief Financial Officer of Patria Bank, and it's my pleasure to guide you through our financial results for the first part of the year. But we'll start with a brief overview of the current macroeconomic landscape, which provides important context for our business outlook and strategic decisions. In 2025, the main macroeconomic focus for Romania is fiscal consolidation to reduce the budget deficit, primarily through measures like a freeze on public sector wages and pensions and revenue increases, while also aiming for growth and economic stability. Key measures include a nominal freeze on public sector wages and pension, increased dividend taxes, and reform for public finances and the tax system, alongside efforts to boost growth through structural reforms and investments from the National Recovery and Resilience Plan. These actions are crucial to secure investor confidence and meet EU funding requirements by the August 2026 deadline. Economic growth has continued to slow down significantly in 2025. In the first two quarters, year-on-year growth was just 0.3%, a sharp decline compared to the already modest 0.8% increase seen in 2024. For context, the average growth rate between 2015 and 2024 stood at 3.4%, highlighting the current deceleration in economic activity. Forecasts for the full year 2025 have also been revised downward, now ranging between 0.9% and 1.4%, reflecting expectation and continuous weak performance in the second quarter. On the inflation front, the rate rose to 5.66 in June and jumped to 7.84 in July, signaling persistent price pressure, which continue to weigh on both consumer and business operations. Turning to public financing, the fiscal deficit reached 9.3% of GDP in 2024, a significant imbalance. Also, public debt remains relatively down at 65% of GDP, it has been increasing at a concerning pace over the past few years. Moreover, the execution of the consolidated general budget for the first half of 2025 ended with a deficit of RON 69.8 billion, or 3.68% of GDP. This is slightly higher than the RON 63.67 billion recorded in the same period last year, which represents 3.62% of GDP. We expect the budget deficit to exceed 8% of GDP again this year. These indicators reflect a challenging environment marked by the modest growth, elevated inflation, and rising fiscal pressure. However, while the macroeconomic outlook is complex, it also presents opportunities for us. I will go further to the banking system evolution. To set the context, I will start with an overview of how the banking system has evolved in the first quarter of 2025, highlighting asset growth, profitability, and stability indicators. As we navigate through an increasingly dynamic economic landscape, the resilience and adaptability of our banking system continue to be reflected in the latest data released by the National Bank of Romania. To begin with, the total assets of the banking sector reached RON 887 billion in March 2025, up from RON 881.8 billion at the end of 2024. This quarterly increase of RON 5.2 billion underscores continued growth, albeit at a more moderate pace, signaling a stable and continuously optimistic outlook. In terms of profitability, the system recorded a net profit of RON 3.7 billion for the first quarter of 2025. While this reflects a 2% decrease year-over-year, the performance remains solid, especially in the context of evolving macroeconomic conditions and continued adjustment to monetary policy. Our key efficiency metrics remain robust. The return on assets stood at 1.67% and return on equity at 18.21%. These are slightly below the figures from the previous quarter of 1.68% and 18.44% for return on equity, but still indicate a healthy return environment and sound banking fundamentals. The non-performing loans NPL ratio was reported at 2.53 at the end of the first quarter, similar with the last quarter of 2024 year of 2.48%. This slightly uptick is being closely monitored, but the NPL level remains low by regional standards and reflects the continued prudent lending practice across the sector. In terms of liquidity and credit activity, the loans-to-deposit ratio remains stable at 67.54%, compared with the similar rate of 67.61% in December 2024. This reflects a marginal slowdown in lending activity related to deposit growth, a development that aligns with current consumer sentiment and broader economic moderation. The system liquidity coverage ratio decreased slightly from 255% at the end of 2024 to 252% in the first quarter of this year, maintaining a strong liquidity buffer. Finally, the solvency ratio, while slightly decreased to 24.17% in March from 24.91% in the fourth quarter of 2024, continues to comfortably exceed regulatory requirements. It also marks an improvement over 22.9% recorded in the first quarter of 2024, highlighting the sector's strong capital position and its capacity to absorb potential shocks. In conclusion, the Romanian banking sector entered the second quarter of 2025 on a stable and well-capitalized footing. While certain indicators show a slight deceleration, the overall fundamentals remain sound. I will give the floor, thank you, and I will give the floor to Valentin, our CRO, for the main results.
Before going into the details, I would like to highlight some figures which at the end of the day reflect our strong development in the first semester. As mentioned before, despite this economic development in the context which imposed at a certain moment due to also the political calendar, strong impact on the banking system, namely the cost of funding increased, the money market, the exchange rate depreciated between the two election rounds. Just for everybody to understand, the money market cost, which is the market where the banks are borrowing themselves, increased in 1 week from 5.5% to more than 7%. Still, we succeeded to manage very well this period and to ensure on both hands a good profitability, but on the other hand, also to stick and to comply with all the prudential ratio. Coming back, the operational result of Patria Bank represents the best semester we had in the last 5 years, which shows a consistent development of our strategy, which we have implemented many years ago after the merger between Banca Comercială Carpatica and Patria Bank. After many years of consistent development, quantitative development, we have come finally in the qualitative development part, which allowed us to obtain a net profit of close to 26 million RON, which represents a hefty increase of more than 40% compared to the last semester. Cost-income ratio less than 70% for the first time in the last 7 years for Patria Bank, namely 68%. As mentioned before, these results were obtained based on an increase of the net performing loan portfolio of 21% compared to the previous semester, and an increase of 18% of the net banking income. Very important, because this is where the investors are looking. Return on assets, return on equity. We have succeeded to pass the 1% figure for the return on assets, and from 0.9 in the last year semester, now we are reaching 1.1%. And return on equity for the first time is more than 10%, from 8.9%, now it's reached 11.7%. This shows a strong increase of our returns based on the operational results. As mentioned before, we are very diligent and always having a prudent approach. We look always at all the prudential ratios, and also here we have a good development when it comes to the solvency. It's more than 21%, also a development from 20.3% previous semester 2024 to 21.8% this year, as well as maintaining a liquidity coverage ratio of more than 140%. As mentioned before, we always look at the non-performing loans, and here we have a very good development coming down this ratio from 4.8% June previous year to 3.4% this June, which is better than what we have budgeted for the year end. We are very proud of this development, because at the end of the day, this shows a very good quality of our portfolio, especially of the new loans, as well as good results of our monitoring portfolio activities. In the same time, we have succeeded to maintain a very good provisioning coverage ratio of 57.5%. Georgiana, please, let's go now into the details of the income structure as well as the cost side.
Thank you. Moving on the income statement and financial performance for the first half of 2025, the results demonstrate solid growth, a resilient operational model, and a clear trajectory towards enhanced profitability. The net banking income reached RON 123.4 million, representing an 18% increase comparing to first half of 2024. This growth was primarily driven by the net interest income, which rose by 27%, highlighting the strength of our lending activity and the effective management of our investment portfolio. Income from financial activities increased by 5%. The moderate growth influenced by market conditions, while net fees and commission were up by 1%, reflecting a well-balanced and diversified revenue stream. For net interest income grew significantly by RON 17.6 million comparing to the first half of 2024, driven by higher loan balances and strategic investment of temporary liquidity excess in securities. Interest expense increased moderately by 4%, reflecting higher commercial funding levels and market interest rate trends, which we continue to manage efficiently. The operating expenses increased by 4% to RON 84.2 million, driven mainly by the expansion of the bank's activity. Also, the bank is investing in IT, cybersecurity system, as well as marketing campaigns, ensuring sustainable growth and operational resilience. Other operating costs decreased slightly, demonstrating our focus on cost discipline. For net impairment and risk management, the bank maintained a prudent approach to credit risk management. Net impairment totaled RON 9.2 million in the first half of 2025 year, reflecting proactive monitoring and write-off operations amounting to RON 6.4 million, in line with our strategy to reduce non-performing loans. The cost of risk stood at 72 basis points, a level that also incorporates a significant portion of the new loans production granted to our clients. New loan sales in the first half year of 2025 reached RON 859 million, representing a 42% increase comparing with the same period of 2024, highlighting the strong growth in our lending activity. Also, in terms of efficiency, cost-to-income ratio decreased from 77% level recorded in the first 6 months of 2024 year to 68% in the first half of the current year. Also, if we exclude the tax on turnover of 2%, the cost-to-income ratio is 65%. In terms of taxation, the taxation level reported by the Patria Bank as of June 2025, calculated by considering the combined impact of corporate income tax of 16% and the 2% turnover tax, results in an effective tax rate of 25%. While this represents a relatively high tax burden comparing to the broader EU, the bank has strong absorption capacity and has still reported the highest net profit for the first half of the year in the last 5 years, reaching RON 25.8 million. This level of taxation of 25% is comparable to developed Western European countries such as Italy, France, Netherlands, and Spain, which have mature and highly structured economies. Net profit for the first half of 2025 was 4.3 times higher than in the first half of 2021, a remarkable achievement in very challenging economic and political environment. This performance underscores the development of the bank's business model and the gain in the operational efficiency. The operating result reached a record half-year value of 39.2 million, representing a significant increase of 65% comparing with the first half of 2024. Net profit rose by 42.3% compared to the same period of last year, reaching a record half-year level of 25.8 million RON. In summary, first half of 2025 highlights the bank's ability to deliver strong and recurring results, supported by a diversified income base, prudent risk management, and disciplined cost control. These results are also reflected in the position evolution of our key financial indicators. The solid growth in net profit and improved operational efficiency position the bank for a robust performance throughout the full year 2025. Turning now to the bank's financial position, we are pleased to report a solid balance sheet expansion and the further strengthening of our financial fundamentals in the first half of 2025. Total assets reached 4.8 billion RON, up to 7% comparing to year-end 2024. This evolution reflects both the growth of the loan portfolio and the increase in investment in government securities, which continue to provide stability and a recurring source of interest income. Liquid assets accounted for 38% of total assets at the end of June 2025, a slight decrease from 39% in June 2024 as a result of the increase of the lending activity. Net loans grew by 12% by 285 million RON, primarily supported by lending activity in SME, corporate, and agriculture sectors. Performing loans advanced by 13% by 302 million RON, while non-performing exposure declined by 9%. Consequently, the NPE ratio decreased from 4.1% at year-end 2024 to 3.4% as of June 2025, underscoring the bank's prudent risk management and commitment to portfolio quality. Gross loans accounted for 58% of our total assets at mid-2025, up from 55% in December 2024, reflecting the continued strategic focus on customer lending as a core driver of growth. Investment and liquidity management. Investment in government security advanced by 8%, contributing to a more balanced structure of our total assets and enhancing interest income. In parallel, the bank strengthened its funding base by expanding on-demand deposits and the overnight convention, which increased by 160% versus December 2024. In amount with 180 million RON increase. As well, the focus was the development of the collateral deposits generated by lending or trading activity, both contributing to enhanced liquidity management and the optimization of funding costs. In terms of capital and equity evolution, for equity, we have an increase by 6% comparing to December 2024, mainly supported by the net profit recorded in the first half of 2025, partially offset by 6 million RON impact from the redemption of shares operation related to the merger process. The operation was implemented at the beginning of the current year. The bank capital position remained robust, with a standalone total own funds ratio, solvency ratio, at 21.76%, and the consolidated ratio at 19.49%, both well above regulatory requirements, including all capital buffers. Compared to June 2024, when the standalone ratio stood at 20.3%, the bank recorded a clear improvement even through risk-weighted assets increase in line with the balance sheet expansion. This ratio also incorporates the profit achieved in the first half of 2025, further strengthening our capital base. Overall, the bank financial position as of June 2025 demonstrates resilience, growth, and effective balance sheet management. Strong lending activity, improving asset quality, disciplined funding management provide a sound platform for sustaining performance and support for future development. Thank you. I'll give the floor to Răzvan Pașor.
A few words about our partnership with international financial institutions. If you have been following us, we count among our creditors the IFC, International Finance Corporation, part of the World Bank Group, the European Investment Fund, the European Investment Bank, and the European Fund for Southeast Europe. What's new in the past 6 months is that the latter, the European Fund for Southeast Europe, EFSE, has granted Patria Bank a second subordinated loan. This has a value of 8 million euros and adds to a first loan granted by the same institution in 2022. This second loan was granted by EFSE in June 2025. Our next section of the presentation covers the commercial and the business side of the bank's operations, and this will be presented by Valentin Vancea, our CEO.
As mentioned before, we had a significant increase of our commercial activities throughout all commercial segments of the bank. So we have a balanced development of the commercial activities in small business, corporate segment, micro, agro, as well as retail. When it comes to the small business segment, we have an increase of 13% of the loan portfolio compared to 2024 year end. And as mentioned before, this sustainable development is based significantly also on the use of the competitiveness credit program, part of the European Investment Fund, which brings a tremendous support for our customers, considering the costs of this guarantee program compared to other guarantees, local programs. I always use this balanced approach. We have the same balanced financing structure when it comes to the sectors of activities. And when we mention the loan portfolio segment, we have a 21% coverage on the commercial real estate, then on the trade activities, approximately 15%, manufacturing 15%, construction sector 14%, and residential real estate 13%. The bank always keeping a very diligent concern when it comes to the significant exposure on a certain commercial segment in order to mitigate the potential risk when it comes to the economic impact. Also mentioned before regarding the loan from the European Investment Bank, we have a strong focus on the green energy sector, and this is one of the main scope of financing as part of the European Investment Bank loan. Micro and agro have always been key segments of our bank. The bank started, and also one of the main subsidiaries of Patria Bank is Patria Credit IFN, which is specialized in micro business financing. We have a strong expertise in this area, and when it comes to the bank, the strong increase of the loan portfolio came also based on new development. We have a new scoring model, and we are very happy to see that in the last month, approximately 1/3 of the new production, loans production, has been obtained through the new standardized scoring model, which gives both an efficiency as well as better risk results. When it comes to the agro and the food business, as I mentioned, we have also expanded our exposure on the food processing, which gives a very strong development and also cash flow, because in the agri business we try to expand the coverage not only on the harvest crops producers, but also on the food processing, which gives a more predictable cash flow of our customers and increased operational activities of Patria Bank with these customers. In a nutshell, the agro portfolio increased by 33% in the first semester, which is a significant achievement. And in terms of structure, 70% represent working capital lines, 20% represent investment loans, and 10% also. And here I would like to mention that we have a very good experience in the implementation and the funding of the projects with EU funds. Retail part also has increased by 10%. Out of which a very important increase comes from the unsecured loans, the general purpose loans of 57% increase, as well as the real estate loans. So we have one of the best products in euro financing in the market, which we launched in the first quarter of this year. Also in June, we have launched in production the new credit card, which is available through the platform Patria de Oriunde. And from this perspective, I will slightly move to our next chapter, which is covering the digitalization in Patria Bank. I would like to underline, as always, that we have implemented digital projects not for the sake of marketing, but for the sake of the efficiency. We always followed better projects, better processes, and a better user experience for our customers. In the first semester of this year, we have launched the Smart API available for the corporate customers, based on which they can import data from the bank system, and they can use it in a better way for their accounting purposes, financial purposes. And we have significantly advanced with our mobile banking new application, which will be launching by the end of the third quarter this year. Also, we have a new product available for the payment institution with the escrow protection account, and here we have a strong focus in the coming period. As mentioned before, for the retail customers, very important, we have the credit card new product, which was launched. And also very important for our customers, retail customers, when it comes to the interest deposits, we always had the best rates and campaigns developed for the Patria de Oriunde. The digitalization at the end of the day, as mentioned before, for us is a key indicator for our efficiency ratios. And when we look at the numbers in the first semester of this year, we have an increase of 22% of the users in Patria Online, and 13% more transactions performed through our platforms. which for us has been very important, and it was a major tool to obtain our increased efficiency, the cost-income ratio below 70%, and the profitability for the first semester of this year. Then I think this would wrap up the digital part, and we should touch a little bit the evolution of the Patria Bank shares and our bonds. And Răzvan Pașor will cover this part.
So as you probably know, Patria Bank shares are listed on the main regulated market of the Bucharest Stock Exchange at the premium category. They are traded with the PBK ticker symbol. During the first half of 2025, the shares followed the same mainly flat trend recorded in previous years, with the closing share price at the end of June 2025 of 0.0810 lei per share. The bank also has two listed bond issues on the Bucharest Stock Exchange. They're traded under ticker symbols PBK27E and PBK28E. On the main market, once again, of the Bucharest Stock Exchange, both are issued in euros and are pretty actively traded. They're some of the most actively traded corporate bond issues on the Bucharest Exchange. The first issue, which has a maturity in 2027, recorded total trades since listing on the exchange amounting to 83% of total bonds traded, so pretty liquid issue. And the second issue, which reaches maturity in 2028, recorded total trades amounting to 59% of bonds issued since listing on the exchange. As for the bank's majority shareholders, investors who have been following us probably know the majority shareholder is called EEAF Financial Services BV. The shareholder held a stake of 84.05% from total issued shares at 30 June 2025. And this is an investment vehicle controlled by a private equity fund called Emerging Europe Accession Fund, which in turn is controlled by international financial institutions, such as the EBRD, the European Investment Fund, or the Black Sea Trade and Development Bank. I think this section wraps up our presentation for today. Thank you once again for attending, and we will be answering some of the questions received so far.
Thank you. Thank you very much for the presentation. We will now open the Q&A session. As a reminder, please type your question in the chat window, and we will address the questions in order received. I will be reading out loud every single question before passing it to one of our speakers for an answer. I see we already have several questions, therefore I believe we can begin with the first one. In the meantime, please type other questions, because once we run out of questions, we'll conclude the call. So the first question is, from your perspective, how is current competition for deposits in Romania? And are you worried that once the National Bank of Romania starts cutting, that you will have some outflows or have to increase the premium to the market to retain depositors?
I will answer this question. So for us, as I mentioned before, we have succeeded to manage very well the liquidity shortage, which all the banks have faced during May, June, and even July. So we are not worried about the competition. Of course, the competition is very tight. Of course, there is a big difference between the local banks, the medium-sized banks, as Patria Bank is, and the large banks, which are part of the international groups. But we have succeeded to obtain our resilience in terms of financing means throughout all these years. As well as we mentioned before, we have a diversified funding portfolio both attracting funds from the local market, but as well as from international investors, very reputable investors. Therefore, from our perspective, we believe that we will be able to manage in the same successful way the liquidity position of Patria Bank.
Thank you. We can move to the next question. Loan book development for the second half of 2025. What trends are you seeing so far? Will end the year in high teens as budgeted, or fiscal measures should put a dent on the yearly execution? And what about next year? How much of an impact in loan book growth do you think these measures plus lower GDP growth will have?
So definitely, as mentioned before, we are facing a difficult macroeconomic context, and therefore all the banks, and I would speak now about Patria Bank, are looking very diligently at the evolution of certain sectors. We see that some of the sectors of activity are more affected by others. If we look at the construction area, they are pretty much exposed to the big infrastructural works or even the works in the local cities. Here we have faced delays in the payments, or simply payments was shifted from one quarter to another. We are seeing a development also in terms of insolvency procedures, which are affecting these areas of activities. As I mentioned before, the construction, we also see the Horeca area affected, plus the transportation. So we are very diligently looking at this. For some of the sectors of activity, we have decreased the new exposure. In the same time, looking very diligently at the early monitoring indicators for the current exposure. But more details on this, I would invite Răzvan Prodă to develop, our Chief Risk Officer.
So as Valentin mentioned before, we started this diligence from last year in order for us to have a growth on the loan portfolio, but also to maintain an NPL ratio according to our budget. So practically what we did, we look at the sectors that are more keen on to the incomes that come from the state, and we tried to go only on the clients that had the possibility to maintain into the market no matter what the conditions are put in there. So as Valentin said, there were some sectors that we decreased in our loan portfolio book, but we are confident that we can manage to realize the budget that we put by the end of the year, and also to maintain the NPL ratio accordingly to our budget.
Thank you very much. We can move to the next question. The net interest margin seems to have expanded a bit in the second quarter. Was it mostly a function of ROBOR spiking in beginning of May, or what was the reason? I'm asking because the composition of the loan book doesn't seem to have shifted that materially. You had increase in loans to entrepreneurs weight in detriment of mortgages, but not sure that would be sufficient to move so much the needle, but please tell me. This will be answered by Georgiana.
For the net interest margin evolution, the increase of the net interest margin was the main driver of net banking income evolution for the first half of 2025. Now, in terms of interest income, the main driver was the expansion of the loan portfolio, and the new loans granted during the year were mainly in local currency, comparing with the previous year when the lending in loans denominated in euro was higher. Second, yes, as you mentioned in your question, for retail we granted more loans for personal loans with higher margins comparing with the mortgage, and around 80% of our new loans for retail are related to consumer loans with higher margins. For companies, As I mentioned, the growth was mainly in local currency, but we have higher yields comparing with the euro loans. Also for interest expense evolution, during the year, we try to optimize our cost of funding, and we focus to develop the overnight deposits, the demand deposits, also the collateral deposits, linked with the lending activity and linked with the trading activity of the bank. This type of deposits have embedded a lower cost of funding comparing with the normal term deposits. On retail, we try to switch and the maturity of the deposits to shorter tenors in order to adapt to the macroeconomic conditions and to the evolution of the yields in the market. And we had a switch of around 30% of our deposits on shorter tenors. But this movement and behavior of the customer deposits is also linked with the demand, because also the clients want to place their liquidity on shorter tenors in order to avoid any shocks or shocks of the market. As a conclusion, the evolution of net interest margin is linked to loan portfolio development, mainly in local currency, and also to optimizing our cost of funding. We also try, in terms of funding, to decrease the high concentration on FI deposits and to replace with lower tickets, and to develop more on retail deposits and to decrease on big tickets wholesale deposits. These are the actions and measures undertaken by the bank in order to improve the level of net interest margin. These actions were both on interest income and also on interest expense.
Thank you. The next question, what dynamics do you expect for the rest of the year in terms of net interest margin, and is the loan to deposit ratio to remain around these levels?
Now we have some restrictions in terms of what information we can provide for the future, because we are a listed company. But of course, we will, according to our budget, we will try to, and we are confident that we will achieve our budget in terms of indicators. And the first part of the year confirms and creates the base in order to keep our budgeted figures and to achieve them by the end of the year.
Thank you. The next question is banking net finance cost is trailing significantly the budget presented. Why is that? And do you still think mid-teens evolution for 2025 is feasible, or would you rather taper guidance here?
So the net fees and commission evolution is in line with our budget, and this is based on an increased number of transactions. As mentioned before, also the digital part has come with a solid contribution here, as well as the trade finance activities. So in the last 2 years, we have increased the focus of our trade finance activities, especially letter of guarantees in relation with the infrastructural project, and definitely this had an impact on the evolution of net fees and commission, which we believe will continue also in the second semester.
Next question, cost evolution is still quite high, but seems in line with budget. However, the new tax on turnover will put pressure here. Approximately how much per quarter are you expecting to pay under the 4% tax on turnover?
So, as mentioned before, we being a listed company, we cannot make a full disclosure of the future figures. But what I can tell you that based on the results in the first semester and the expectation on the evolution in the second semester, the bank will be able to achieve the budgeted results, meaning to be able to compensate and to cover the increased tax on revenue, on turnover.
Thank you. Asset quality. The non-performing loan stock continues to fall, but there was a significant increase in stage 2 loans. Why was that, and is that any reason for concern? The cost of risk for 2025 around 100 basis points still?
Yeah, so I'll begin with the last question. Yeah, we are confident that the core will remain in line with the budget what we mentioned for 2025. And coming to the first question, with stage 2, our level of clients in stage 2 is in line with the bank system. And also this came because there were some measures taken by the Romanian government in order to help clients in agribusiness that are now coming to an end. So we are estimated that by the end of the year, this stock in stage 2 will decrease because the clients for the agri business this year was very good, was not in a drought as in the last 2 years. So this trend, I think, will gonna decrease by the end of the year. So the stock in the stage 2 will decrease also.
Thank you. The next question, finally, on the EAF signaling intention to reduce or fully divest. Any color you can give? What are they thinking and why they want at least partially to exit, and what are your thoughts on it?
We have to take into consideration, at the end of the day, the shareholders of Emerging Europe Accession Fund, which are European Investment Bank, the Banking Development Bank in Germany, the Black Sea Trade and Development Bank, and the European Investment Fund. These are reputable financial institutions. Also to consider that the investment of EAF in Patria Bank is more than 9 years. This is a normal procedure to simply look into the market and realize what would be a potential interest of potential investors. Nothing else, nothing more. This, in fact, what I mentioned before, the long-term shareholding in this bank represents a strong commitment of EAF.
Thank you. And the final question. In the last 3 years, bank had received 3 tranches of subordinated loans. What was the driver behind this? Also, why did bank shift to a more growth strategy in a year of higher uncertainty and lower GDP growth? Does the bank plan to close any branch to lower the cost-to-income ratio further?
In terms of strategy for our own fund structure, the subordinated loans represent the improvement of our Tier 2 level. For Tier 1 level, our profitability contributed directly to the increase of the level of Tier 1 own funds. And in terms of our strategy, growth strategy, we are confident in our business model that proves that robust increase and consolidated our profitability. And we try to adapt to the market condition to have a prudent approach in terms of lending. Our cost of risk reflects this, and also the evolution of our NPL loans reflect a strong improvement of our loan quality of the portfolio. Related to the last question that you addressed is the bank plan to close any branch? No, we don't have a plan to close any unit.
Thank you all very much. I believe we can conclude today's teleconference, and we would like to thank you all for the participations and the questions that you have submitted. We hope the answers are helpful. Should you have any additional questions after the call, please feel free to reach out to us at capital@patriabank.ro. We wish you all a great day ahead and looking forward to hearing each other at our next teleconference. Thank you all for joining.